Here's what they're not telling you. In the last session, I said if silver lost the $28.40 zone with momentum, it wouldn't just drift lower, it would get slammed into a liquidity pocket where weak hands get forced out fast. Not 28.10, not 27.90. That specific zone, price sliced through it overnight, printed straight into the 27s, and as I'm recording this, it's hovering right around the mid-27 handle after a violent flush. That wasn't random volatility. That was level-to-level movement, engineered liquidity, and a very deliberate push into thin order books. And gold didn't escape either. Gold slipped under short-term support, lost its intraday structure, and followed silver lower, not because of a sudden collapse in demand, but because of coordinated pressure across the paper markets. That distinction matters. Because when price moves fast without the corresponding physical volume, you're not looking at organic selling. You're looking at positioning. Now, here's the development mainstream coverage won't touch. Overnight, futures volume spiked during low liquidity hours, primarily in the electronic session, where it takes less capital to move price further. That's where the bulk of the selling hit. Not during peak New York hours when liquidity is thick, during the window where fewer participants can absorb the move. That's textbook. And at the same time, the physical premiums in the East didn't collapse, they widened. That divergence is the story. Paper price down, physical demand steady or rising. That's not a collapse in interest. That's a disconnect between the derivatives market and the underlying metal. If you're actually tracking this in real time, verifying numbers, watching the levels, comment metal watch below, simple check-in. It tells me who's paying attention and who's just reacting to red candles. And if you're not following the intraday updates, you're missing half the story. Because most of what matters happens between closes, not during them. Now, current snapshot as I'm recording. Silver spot trading around the high 27 range, futures roughly in line, gold spot sitting just under the recent intraday. Support it lost earlier, hovering in the mid-2000s after slipping from the prior session's highs. The dollar firmed slightly, yields moved, but not enough to justify the magnitude of the drop we saw. That gap between cause and effect is where manipulation narratives gain traction. Let's talk positioning. Open interest didn't collapse with price. That's important. If this were true capitulation, you'd see a massive drop in open interest as longs exit in panic. Instead, you saw modest reductions and a lot of rolling. Contracts moving forward, not disappearing. That suggests repositioning, not abandonment. And when you combine that with the timing of the sell-off, you start seeing a pattern. Push price down hard, trigger stops, force liquidations, shake out weak holders, then let it stabilize. It's not a new playbook. It's been used across commodities for decades. Now, let's look at exchange-side signals. There's been increased scrutiny on certain high-frequency trading patterns in the overnight session. Not formal charges, not dramatic headlines, but internal notices and compliance chatter about spoofing-like behavior. Large orders appearing and disappearing to influence direction. Again, not proof of wrongdoing in every case, but when you see it cluster around major price moves, it raises eyebrows. Exchanges don't like disorderly markets because disorder undermines confidence. And when confidence erodes, participation drops. So when enforcement ramps quietly, it usually means something crossed a line internally. On the technical side, short-term structure broke. Silver lost the 50-hour moving average and couldn't reclaim it on the bounce. That turns prior support into resistance. The next meaningful support sits lower, and until price reclaims the broken levels with volume, the path of least resistance remains vulnerable. But here's the nuance. You don't need to be bullish or bearish to observe that the move down lacked follow-through volume in certain segments. Big candles, yes. Sustained heavy selling across all sessions? No. That kind of move often signals a liquidity event rather than a fundamental shift. Liquidity events can reverse just as quickly as they appear, but only if buyers step in with conviction. Macro backdrop matters here too. Inflation expectations, rate cut speculation, and dollar strength all feed into metals pricing. But none of those variables changed dramatically enough in the last 24 hours to justify a synchronized slam across both gold and silver to this degree. That's why traders start looking at positioning rather than headlines. Who needed price lower? Who benefits from stops being triggered? Who gains from forced liquidations? These aren't conspiracy questions. They're structural ones. Markets are ecosystems of incentives. When incentives align for a move, the move often happens. ETF flows offer another clue. Early data shows modest outflows from some silver-backed funds, but nothing resembling panic, not a mass exodus, not the kind of liquidation you'd expect if investors suddenly lost faith in the metal. Instead, small reductions. That suggests the drop didn't come from retail dumping holdings. It came from leveraged positions unwinding or being pushed out. There's a difference. Physical holders tend to move slower. Leveraged traders move fast because they have to. Margin calls don't wait. Now, zoom out to liquidity conditions. Broader markets have shown signs of tightening liquidity in recent sessions. Not a crisis, but subtle stress. When liquidity tightens, volatility increases. Assets that rely on leverage become more sensitive to shocks. Precious metals, especially silver, sit at the intersection of macro hedging and speculative trading. That makes them vulnerable to sudden moves when liquidity thins. So when you see coordinated selling across risk assets and metals simultaneously, you have to consider the possibility of forced deleveraging rather than purely discretionary selling. Globally, central bank behavior hasn't shifted away from metals. Gold accumulation trends remain intact in many regions. Silver demand from industrial sectors continues to fluctuate with economic data, but it hasn't collapsed overnight. That's another disconnect. Physical demand doesn't evaporate in a single session. Paper price can move instantly. Physical trends move slower. When those two diverge, you get volatility and confusion benefits those who can navigate it. Let's address the bear case, honestly. If silver can't reclaim the broken support levels and continues to trade below them, downside risk remains. Technical traders will target the next support zones. And if those break, momentum can accelerate. Gold slipping alongside adds pressure because the two often move in tandem. A stronger dollar and rising yields, even modestly, can cap rallies. And if broader markets continue to experience liquidity stress, metals could see additional forced selling as traders raise cash. Those are real risks. Ignoring them doesn't help anyone. But here's the counter. Physical premiums holding firm. Open interest not collapsing. ETF outflows modest. Timing of the sell-off during thin liquidity. All of that points to a move driven more by positioning than by a structural collapse in demand. When positioning-driven moves exhaust themselves, price often stabilizes and recalibrates. Not necessarily rocket higher immediately, but stabilize. The key question now is whether buyers step in at these lower levels with enough conviction to absorb the supply. If they do, you get a base. If they don't, you get another leg down. Watch the next sessions carefully. Does silver reclaim the broken support with volume? Does gold stabilize and hold its own key levels? Does the dollar continue strengthening or does it stall? Do yields spike or do they flatten? Markets don't move in isolation. They move in networks. And when multiple variables align, trends emerge. When they diverge, volatility dominates. What matters now isn't predicting the exact next tick. It's observing how price behaves around key zones. If silver holds above the next support and starts building a base, that tells you the slam may have been a liquidity event rather than the start of a prolonged downtrend. If it continues bleeding lower with expanding volume, that tells you the pressure hasn't finished. Same with gold. Reclaim lost. Levels with conviction and the narrative shifts. Fail to do so, and caution remains warranted. The broader takeaway is this. Today's metal market crash wasn't a single factor event. It was a confluence of technical breaks, liquidity conditions, positioning dynamics, and macro cross-currents. Simplifying it into one headline misses the complexity. And complexity is where opportunity often hides. The traders who survive these environments aren't the ones reacting emotionally to every red candle. They're the ones watching structure, volume, and positioning. They let the market reveal its intent rather than forcing a narrative onto it. So keep an eye on the levels. Keep an eye on the premiums. Keep an eye on the open interest. Watch how price behaves, not just where it goes. Because in markets like this, observation beats prediction. And the ones who stay disciplined through volatility are the ones positioned when clarity returns.